So thanks everybody for joining us. I'm doing this because I had some help and I wanted to introduce other folks that may need the same type of assistance that I had. So I met Claudio Gambin, and Claudio Gambin comes from a whole wealth of industries, including wealth building and tax strategies. But he got into tax strategies mainly because he was a business owner. He sold some business and he got chewed up with taxes. So he wanted to find a way to be able to help that his CPA and most CPAs just don't see. So first of all, I want to welcome Claudio Gambin.
Thanks, Bruce.
I've known Claudio for about a year now, and I thought this would be beneficial for a lot of my clients and a lot of my VIP friends as well. So thanks. Appreciate you joining me today.
Of course. Thanks for the opportunity.
You're very welcome. Tell me a little bit about you and your business.
Yeah, GFT Solutions, the business we started in 2020. I came from the wealth management space. And as we built out wealth management, we had the opportunity to invest in a couple of different businesses that we had some healthy exits. And through that process, Bruce, we paid a lot of dumb tax. We paid a lot of real tax, so we paid a lot of dumb tax. And when we got out of the wealth management business altogether, sold that off and started the consulting business specifically to help with strategy geared towards business owners, really based off of a lot of the mistakes that I made. So the business today is designed to help business owners, three key areas: risk management. So making sure no matter what happens, no one can take what you've built. There's enough of a byproduct of risk as being a business owner. Tax strategy. How do we make sure Uncle Sam is the smallest business partner you could possibly make them? And number three is around growth and sale.
Very good.
We all get into business because we want to make more money and have more time, but we inevitably find ourselves working longer hours than we ever had and really struggling from a cash flow perspective. So my job is to help optimize the balance sheet, the business, and get you prepared for a sale.
The most boring part of anybody's life, and yet we're going to help save you a lot of money. So I've got some questions for you that I put together. Asset protection. So asset protection, so you had a three-legged stool that you had really devised, and you put it in perspective with a three-legged stool. What do you mean by that?
Asset protection really comes down to a couple different things, but there's so much that can happen there. But at its simplest format, it's how you own your assets, it's where you own your assets, and how you insure your assets. We can go super complicated as it relates to asset protection, but for the sake of the audience, for the sake of just how much time we have today,
through this and getting as much out of this as we can.
Yeah, you want to make sure you own your assets in a very effective manner. You want to make sure that you own some layers of protection. You want to have a holding company that owns your companies. You don't want to own anything directly. As they say, the wealthy control everything, but own nothing.
It's so true.
Right? So the way we do that is we structure the organization so that you have a holding company that owns everything, and then you own said holding company. And it could be personally, it could be through trust. There's so many different ways. But one of those easy, simple hacks of asset protection is insurance.
Right.
Most people buy insurance and never think about it ever again. Our firm goes through and audits our clients' insurance on an annual basis to look for gaps, overlaps, weaknesses, because when you need your insurance the most is when something bad happens.
Absolutely. But there's other tools to use insurance for.
Of course. Oh, so many other tools. But my point is from an asset protection perspective, let's make sure what you have is what you need to have in the right kinds of insurance.
Very good. So when you do that, you audit whatever insurance you have, you audit the tax returns, you audit the business tax returns. What are you looking for to be able to help somebody when it comes to insurance and protecting?
So when someone builds out their insurance portfolio, let's just say they're buying a piece of property, they go and get homeowners insurance. It tends to be the only time they think about that coverage.
Right.
But what happens to your property over time? It typically goes up in value. What happens to your net worth over time?
Should go up in value.
If you own a business, what happens to the business value over time?
Goes up in value.
So why do we only address it at first and we never think about it ever again? When you start something and it's worth $1 and you insure it for $1, and then 5 years later it's now worth $10,
and you only have
you need to
for
update the insurance.
Absolutely.
It's that simple.
Absolutely. But there's other things you do with insurance. I want to ask you this. Let's talk about cash flow strategy.
Yes.
Okay. You always say if it doesn't grow, it goes.
Yeah.
What do you mean by that?
All right. So as it relates to the growth of anyone's business, all too often I see business owners go from bare bone startup and they slowly start getting success and they find themselves in a position where they're relatively successful. And they start losing focus on how to reinvest their dollars. So I say, when I look at a P&L for a client, is where are your growth revenue dollars and where are your service revenue dollars to identify what's being used where.
Okay.
And if I look at a business owner's P&L, all too often there's so much leakage. There's so many dollars being spent on lifestyle assets. I finally got the boat I wanted. I finally got the red Porsche I wanted, whatever it may be. And I'm just going to tack that onto the business. And then you try to figure out why your business isn't profitable anymore. So if it doesn't help your business grow, it's got to go.
It's got to go. So most business owners focus on revenue. Why do you focus on balance sheets and liquidity?
Yeah. So specifically as it relates to the economy today, okay, I'm gonna take this a little bit long-winded, but I think it's going to be really valuable for the audience. We've been in business for 17 years. This business specifically since 2020, but I've been in this industry for 17 years. And it was really interesting to see what helped business owners thrive during down markets versus which business owners simply survived or barely survived during down markets. Okay.
Okay.
And the one thing that made the biggest difference between thriving and surviving is liquidity.
Okay.
So when I look at it and I look at a business revenue, that's all ego. You can have $100 million business with a 1% profit margin,
but no liquidity.
and no liquidity, right? So that's all ego. Where it really matters is the balance sheet and your liquidity / cash flow. That's where things really matter. And when it comes to a down market, most businesses that really crush it, they do well during up markets, but they do extremely well during down markets. Why? Because they take advantage of the opportunities in their industries. And the way to do that is to have a strong balance sheet with really healthy liquidity. Because if you've got a strong balance sheet and liquidity, you can then take over marketplace. A marketplace can be taken over by two things: market share and talent. And let's say I'm in the mortgage business, and we all know what's happened in the mortgage business over the last several years.
Last 3 years. Yep.
And if I've got an incredibly strong balance sheet and I've got really healthy liquidity, which is what makes this balance sheet strong, I can go get talent at pennies on the dollar
That other people can't get
because
they're laying them off, and I can hire all the talent.
yeah. And then
Makes sense.
when the market's down, Bruce, what's the first expense that goes? Marketing, right?
Yes.
Which means to market becomes incredibly cheaper, but now I have liquidity. I can double down on my marketing and I can go pick up the market share because the mortgage business didn't die.
No, it did not.
It just went away. It's just
slowed
hiding.
down.
It's
Yes.
hiding. Still, people are still buying homes.
Sure they are.
So if you have market share and you have the ability to continue to market and you can get talent, you just took over people's business. You
That
cleaned
makes
them
a
up.
lot of sense. So how does tax planning directly improve cash flow, not just reduce taxes?
It's found money, right? So a lot of times we talk about this balance sheet liquidity opportunity and people come to me and go, how am I supposed to build my balance sheet? Stop giving so much money to the IRS. Let's start there,
It's one thing.
right? So when we look at tax strategy, and let's hypothetically say you're making $500,000 a year,
Right.
and you do absolutely nothing like 99% of the population. Come January, you start thinking about taxes, and you go, oh man, I got to do something. I'm going to get all my documents to my CPA. April 15th, he's going to say, Bruce, congratulations. You owe $175,000 in taxes.
Right.
You're going to complain and bitch about it,
But you're
but
going
then
to
you're
do
going to
it.
figure out a way to pay it. And then you're not going to think about it. And then the year's going to end. And you're going to do this all over again.
all over the next year.
How you get smart here, how you improve your tax strategy, improves your cash flow, increases your balance sheet is because November, you're going to have built a tax strategy that's going to reduce your tax liability from 175 to 75 or 50
Right.
or less. Let's just say it's 50. We have $125,000 that we did not have before.
That's more money I can run my business with, more talent I can hire.
Exactly. But so it's not what happens with tax strategy that makes a difference. It's what you do with the impact of said tax strategy that's going to make a difference.
Why don't more CPAs pick up on these things? Why are these just missed?
It's not the CPA's job. The CPA's job is to prepare your taxes.
But they're supposed to advise you on the things that need to be your opportunity.
So first and foremost, CPAs are regulated and they have to be quote unquote IRS agents.
Okay.
CPAs help you taxes, not help you save money in taxes. Not all CPAs, but just most. Most CPAs are going to tell you what you owe looking in the rearview mirror. They are past people. They're going to look in the past and tell you what happened.
I see.
Our firm and tax strategy looks into the future and say, here's what it's probably going to happen. What can we do ahead of time to make a difference?
And so then you audit taxes, then you meet with the CPAs, and you even invite them to challenge your strategies.
We have to, because we're not CPAs. I'm not going to file your taxes.
Right.
So I collaborate with the client CPA to make sure that things get done in the manner in which we set them up to get done. Now, here's where it really matters, okay? The right CPA is going to welcome this conversation because they have your best interest in mind.
Sure.
The wrong CPA is not going to welcome this conversation and brush it off as a scam or a scheme or this or that. The reality is, the truth of the matter, the reality, all of it is built for you. The tax code is built for the entrepreneur by the entrepreneur.
But it's up to the entrepreneur to find it.
That's it.
And they don't. They just go through the motions.
That's it.
And I've used the same CPA for 30 years. Great guy. You've met with him before. I told him, challenge everything Claudio has to say, anything. And I don't want to be audited either. So I don't want to go out there and do some cockamamie thing that might save me 50 grand in taxes. And then I'm up for an audit. So we still want to fly under the radar. Is that right?
Here's how we do it. I'm sorry to interrupt you, but here's how we do it. We don't abuse it. Pigs get fat, hogs get slaughtered.
Yes.
We look at aiming at an effective tax rate that makes sense for where you are in life. So if someone pays $0 in taxes, is it going to be easy to get them a mortgage?
They pay no dollars in taxes?
Yes.
Only on my DSCRs and bank statement programs.
But my point is, for the most part,
I
you
understand.
want to show some income.
You have to show income. You have to show income. You have to show assets. You have to show credit.
That's it.
And if you're not showing any income,
it's hard to get a loan.
it is.
So my point is, we're not going to go from paying $500,000 in taxes to zero.
No.
We're going to trend you down. We ultimately want to land at a goal at around 8 to 10% effective.
So you're saying that a business owner, a self-employed person, can physically get down to about a 10% tax bracket?
If they're not, they're being irresponsible with their profits.
Because we all understand that if you're making $500,000 or more a year, you're going to be at a 30% tax bracket?
Yeah.
That's what everybody thinks. That's normal. But you're saying that's not normal.
That's not normal. That's
It's
what
average,
happens.
but it's not normal.
But there's a reason
Interesting.
why the first million is the hardest, because that's where you pay all your dumb tax.
Yes.
Now, you can choose to make your first million 10 times over, or you can learn all your lessons and do things differently, because the second million doesn't cost you $300,000 in taxes.
Not if you're smart.
It should only cost you 100.
Interesting. Interesting. So I want to go back just a little bit to a strong balance sheet and high liquidity. So how much liquidity should a business owner really have? What do you recommend? Is there a number? Is there a percentage?
Yes and no, but here's what it is, right? If you think about the operations of your business, anything above basic operational capital, so operational capital should be idle capital, should be idle cash.
Yes.
Money in the bank. Anything over operations should be level 2, which is not idle, but close to a cash equivalent as possible.
Okay.
So the way I run my business is I keep my operational needs, which varies depending on the seasons, right?
Of course.
Some seasons are busier than others. Anything above that, I move to a cash equivalent type of a bucket where it's making me money. It takes me 48 hours to get to.
Okay.
Anything above that, to me, is full-blown investment dollars. Now, investment dollars means investment in other things, but also investment in these things.
Okay.
I diversify my business based upon cash flow, not based upon return.
Okay.
Let me kind of walk through
Explain
that.
that.
Let me walk through that. As a business owner, my number one best investment is this business. It's not the S&P 500. It's not real estate. It's not anything else. It's this business.
This is what makes the money
This is it.
to invest in the S&P
Yes.
500 or wherever you're putting your money.
So I've got my operational capital, and then I've got my stage 2, which is typically invested in very safe, conservative, liquid assets.
Accessible if you need it.
Stage 2 is double operations.
Okay.
So if my business needs at any given moment in time around $500,000 to run, I've got $500,000 in stage 2.
Okay.
Okay.
All right. Fair enough.
Now it depends on the division of them that I'm moving in. If I know I'm going to be buying real estate for my business, then I've got to increase stage 2.
I see.
Okay. But anyways, 500 and 500. Anything over that threshold, I diversify out. Now, if I know I need to launch a new product or I need to hire more salespeople, I'm going to take that and reinvest that back into my business.
Okay.
If that's not part of my business plan, I'm going to reinvest in other assets. Now, I'm not completely focused on just return. I would rather earn a smaller return, but have cash flow than earn a bigger return and have no cash flow.
Makes a lot of sense.
Here's why. Let me tell you
me.
why.
Yep.
Because if I've got cash flow, I can operate my business. If I've got cash flow, let's just say I take money and I diversify it out and I'm getting $100,000 a year in cash flow.
Okay.
That's $100,000 a year. I have to take less out of the business, which strengthens my business balance sheet, increases my business's liquidity, which gives me the power to go make really strong business moves, which is why cash flow is so important. If you are a doctor working at a hospital system and you're making a W-2 salary and you are earning, then you have a 401k and you do not have a business, different conversation.
Sure it is.
As a business owner, cash flow is king on every decision you make.
Now, do you analyze each business that you're working for or contracted for and give them tips on what they may
Yes.
be able to clean up?
Absolutely.
Good.
At the end of the day, if you're not careful, a business will become a lifestyle asset like that. And myself included, I have moved into a lifestyle asset and then I've had to clean up the business to get it really profitable. At the end of the day, the business is your engine, your wealth engine to your life.
Right.
Your business is not your life.
Sometimes it feels like
Sometimes
it is.
it feels like it. But if it feels like it is, and it probably
You're
is,
not doing it
you're
right.
doing it wrong.
You're doing it wrong. Okay. And I have done a lot of things wrong. I am the number one guy that's made all the mistakes, paid too much taxes. So,
This year.
but however, I do learn. And that's why I consult with people like Claudio that have talents that I don't. He comes to me for a mortgage. I come to him for advice when it comes to strategic planning. And he does do more than just strategic tax planning, but we'll get into that on another note. So you also say cash equals talent equals marketplace. What does that mean in practical terms?
Liquidity, right, equals your liquidity plus talent equals marketplace. What I mean by that is what I was sharing with you earlier. The more cash you have, the better talent you can get. The more talent you can get, the more marketplace you can get. Because your business is mostly, right, your people.
Mostly my people.
You can have the best product in the world, but if you've got shitty people, it's not going to go absolutely
and matter
anywhere.
of fact, it's interesting you say that because to be honest with you, most mortgages are pretty close to the same rate. You can shop around all you want. There's not going to be a lot of difference. It's all coming from mortgage-backed securities.
That's it.
So what do you have? You have talent.
And experience.
And it takes money to hire the right talent. Talent isn't free. Talent costs money. So if you have more liquidity, you can get better talent.
In a service-based business like mortgage business, right? It's a service-based business at the end of the day.
Very much.
Your talent is your COGS. It's your cost of goods sold. If I'm making a widget like this, my cost of goods sold is the raw material, the shipping,
Yes.
the inventory, right? But in our world, we're service-based.
That's it.
Our cost of goods sold is our people. So
They are our product.
the quality of your product is your people.
They are our product.
That's it.
In essence.
'Cause
Absolutely.
You can go anywhere else to get this sort of service.
So I want to ask you then, should we move on to like double leverage models? We've talked about that, or
I don't know, man.
succession
I think
strategy.
it's February.
Yeah.
Let's talk about taxes.
Okay, let's talk
Let's
more
talk
about
about taxes.
Do you want to talk about calculator demos?
No, let's do this. Let me walk them
Walk me
through
through.
my approach when it comes to tax
Why
strategy.
I had to hear more about
Okay.
this than I do, and that's what
All
I'm bringing
right.
to
So when I'm looking at tax strategy, I am looking at it at a very specific formula. First and foremost, we got to identify the problem. The problem being is how much you owe in taxes. Unfortunately, next time we'll do this in like October so people can really make a big splash
right.
on their tax bill. But if I am looking at a big tax liability, I'm going through a certain set of formula. Number one is I'm looking at credits. I'm trying to identify any and all tax credits that I can apply for that's going to impact my tax liability. Now, there are research and development tax credits. You've got energy tax credits, all kinds of credits that can make a difference in what you owe. Why do I start with credits? Because number one, $1 of credit equals $1 off of your tax bill. Okay. So example, if I write off $1, it only saves me 30 cents on my tax bill. But if I have $1 credit, it's $1 off my tax bill.
Beautiful.
So that's number
Dollar for dollar.
dollar for dollar, right? Number two is depreciation. I'm really focused on depreciation. So a lot of real estate people in the audience, you're looking at cost segregation studies.
Yes.
If one of your clients bought a piece of property last year and they are a real estate professional or they qualify for some of these loopholes, such as grouping election, short-term rental loopholes, they may be able to use a cost segregation study to depreciate said property against their 2025 income, and they can do that still for last year.
They can't.
They can.
Okay. Even though we're in 2026.
Even though, yeah.
Interesting.
Now, real estate professional can be a lot of different ways. If you are in real property trade, so some version of construction, roofing, HVAC, electrical, plumbing,
Right.
if you are in the trades and you work on real estate, which you work on properties, you are considered a real estate professional, which means if you have an investment property, you can then use cost segregation study to reduce your tax liability.
Okay.
Even if you bought something in 21, 22, 23, 24, and you haven't done this yet, you can still
go
do
back.
it for 2025.
Do you amend that year's tax
do not.
returns, or you can bring it
in.
forward?
Absolutely. There's a lot of nuance here. There's a lot of specifics. Generally, you can. But the depreciation happens in all kinds of assets.
Sure it does.
1245 assets, which are like heavy equipment assets,
Right.
SUVs, things of that nature. So I'm looking at what can I depreciate that I bought in 2025.
Is the Augusta Rule part of that as well?
That's the next step.
Okay. Let's talk about that.
The next step is deductions. Deductions are the reason they're number 3, not number 1, is because you have to actually have spent the money. So you have to have spent the money in 2025 for you to be able to deduct it. Unfortunately, all too often, CPAs love to miscategorize deductions. They'll say, oh, that is not a marketing expense. That's entertainment, which is not deductible. It's your job to help the CPA understand why this is a marketing expense and not an entertainment expense. Fully deductible, not deductible. Okay. So I would imagine there's significant amount of expenses that have happened with this audience that your CPA is saying that's not deductible. That's considered a distribution. Now it's taxable. And you go, oh, wait a minute. This is an ordinary and necessary business expense. Is it an ordinary business expense? Is it a necessary business expense? If so, it is deductible.
Okay.
Now, again, pigs get fat, hogs get slaughtered. Rolexes,
Don't get greedy.
Rolexes are not an ordinary business expense.
Correct.
Nor are they a necessary business expense, even though having a watch is ordinary and
So
necessary.
that's really the litmus test. Is it necessary? And is it ordinary?
Yes.
So if it meets that litmus test, then it's likely is a deduction.
It likely
a deduction is money that's already spent. So
Yes.
people look at it. When I look at tax returns every day, they look at it and they'll say, I didn't make that much money because I had all these deductions. So are more deductions better? Does it make, I know it reduces your tax consequences, but are there other ways to do it that make things better?
Yes. There are a bunch of ways, but let's keep it real for a minute. Spending $1 to save 30 cents is bad math.
Totally bad.
So if you get the advice from your CPA at the end of the year that goes, hey, you just got to go spend more money so you pay less in taxes, that's bad math, right? However, if you need to spend the money to help your business grow, now that's makes sense. I'm going to go spend $1 to go make $5 and I'm going to save 30 cents. Good math.
Very good.
Okay. And there's a few things that you can do that allow for you to double dip, like the Augusta. The Augusta rule specifically is a deduction that allows for you to rent your home to your business for up to 14 days. Okay. Not more. And the rent that you receive personally is tax exempt. But the business
Tax exempt, not a
tax exempt,
deduction.
not a deduction. So if your house is worth $500,000, rule of thumb is roughly 1%. You're going to rent that house for roughly $500 per day times 14 days. $7,000 that I receive is tax exempt. And the business gets to write that off, which means you save 30 cents. So $2,100 saved.
So when I do events at my house, whether it's a client appreciation,
You are renting your home to your business.
I rent the home to the business. I have to document that now.
Yes.
You've got to thoroughly document it. Same as if I brought people to the boat and entertained them on the boat. I have to thoroughly document that it was business related, but then that is not a deduction,
Tax exempt.
tax exempt.
So as a part of this, what we're going to do is I'm going to send this to you and your team and you can forward it to everybody. For the Augusta rule, for some of these other things, and really as a part of this whole presentation, I've got templates, I've got best practices, I've got everything you need to be successful here in a book. So I'll send it to you and you can just
Beautiful.
forward it to everybody and
Okay.
you can just pull these templates out. Templates like corporate minutes, templates on best practices, templates on what the lease looks like between you and your home.
I
Between
love
you
it.
and your business. Another one is kids on payroll. All 4 of my kids are on payroll.
So are mine. I only
We-
have 2.
We pay them 16. I've got a 9, a 6, a 3, and a 1. The 1-year-old works really hard. let me
Yeah,
tell you.
thank you.
So they all get paid $16,000 a year. I get to write it off, and they do not have to pay taxes on it because of the standard deduction.
I don't know how many of you are doing that. You're probably giving them the money and not taking the deduction. That's probably what's ended
Yeah.
up happening anyway.
Same thing with my parents. I take care of my parents financially. The business pays for them financially. I could easily just give them the money, but instead, I pay them a 1099 to do a job at GFG. And then at the end of the year, I gift them the taxes due on that
Interesting.
because I'm going to give them the money regardless. So I might as well get a tax benefit.
That's amazing. What do you want to move on to now? You want to go on to succession strategy or tax calculator demo? Do you want to do strong? What do you want? What do you want to go?
Well, what do we maybe spend the next 5 or 10 minutes?
Questions and answers?
No,
or-
let's talk about growth. Let's
Okay.
talk about growth. I
Let's
want
do
to
it.
spend a little bit of time there, right? Because you're going to take my handbook, you're going to take the lessons we're going to share with you, and you're going to implement these. And you're going to save at least something for 2025, right? So being a part of this conversation for the next 40 minutes, for the last 40 minutes, is going to generate an ROI, a monetary ROI for you if you choose to implement it, okay? Now, the number one piece of advice I have you on taxes before we get out of there is you have to be proactive. Tax season is not January through April. That's tax preparation season.
It's all year.
It is June to November. That's tax season. That's when you implement your strategies, because if you don't do that, you're leaving so much money on the table and you simply just don't care about money. That's my opinion. Okay.
Okay.
So you're going to use my handbook that I'm going to pass out to everybody to make a difference. And what I want you guys to do is to take the money you're going to save and I want you to focus it on growth in your business.
Okay.
Okay. I don't want you to go buy a new iPhone. I don't want you to go buy a new car. I don't want you to go.
Something that's going to help you produce
Yes.
more business.
Now, there's a lot of different ways you can do this, but number one is I want you to think about leverage.
Okay.
Leverage or debt. Okay. As we think about it. If you borrow money to buy something that's depreciating in value, that's just debt.
It's debt.
If you borrow money to buy something that's appreciating in value, that's leverage.
Absolutely.
Okay.
I talk about leverage to my clients all the time. You get a client that says, I got $500,000. Should I go pay cash for a house? And I say, no, you should take the $500,000 and go buy 4 houses.
Absolutely.
That's leverage.
So we like to call that the double leverage model. Okay, let's talk about that for a minute. So for most of my clients, when it comes down to me optimizing their balance sheet, step one is understand their operating cash flow. Step two is build their stage two.
Right.
Above their stage two, we build an ecosystem for them. Okay, and the ecosystem is this. We take their liquidity above stage two,
Okay.
and we invest it in safe assets.
Okay.
Treasury bills, municipal bonds, insurance contracts, all kinds of different things that I know I'm going to get a safe to guaranteed return. I know it's liquid, which means I have access to it within 48 hours. And because it has those two features, I can leverage it, which means I can post that asset as collateral
Okay.
and borrow against it.
Absolutely.
And then I use the line of credit to make secondary investments, venture capital, alternatives, real estate. And when I do that, guys, what's happening is I'm making money in two separate places for my clients. The first stop, I'm making, call it 7 to 8%. And when I borrow it out, I'm borrowing it at 5. And then the line of credit, I go make another investment and I'm going to go make 10 or 15. I'm making 8 plus 15, 23,
Yes.
minus 5.
Yes.
Now, cherry on top is the secondary investment is focused on cash flow.
Okay.
Cash flow
Explain what are you doing?
goes back up to liquidity,
Okay.
which increases liquidity, which allows for me to stop number one, which increases the line of credit, which allows for me to make better cash flow investments. Then I keep this ecosystem going until a down market comes. When the down market comes, I unwind it because none of it's market correlated, and I reinvest it back into earning market share for the client.
So, for instance, let's just make it simple. We got a line of credit. Say I got a line of credit for $1 million, right?
Yes.
I use that line of credit. It's costing me 5.5%, 6%, whatever the market's going for right now. But if I can take that money and make
12.
9, 10, 12, 20, then I've got positive, I got a 15% gain on that.
That's it.
I got a 50, but you're taking that gain and then you're taking that and then reinvesting that again.
Correct.
Okay. So then we're keeping that in
an ecosystem.
circulation.
It's an ecosystem, right?
Why they call it currency.
But at the end of the day, what it comes down to is intentionality. You've got to pay attention to what's happening. And all too often, and this is what I wanted to get into the growth side, all too often, we're so busy running our business.
We forget.
We do not look up and look around for opportunities. We're not paying attention to what's happening with trending. Every single one of you is an expert in your industry.
But do you think it's they don't know what they don't know what they don't know? Because if they don't know how to do that, you think your CPA's got this under control. You think your financial planner has it under control.
That's not true.
But you don't think most business owners
No.
think that their CPAs just got this and they're doing the best they can for them?
No, I don't think so. Here's my opinion. I think they tolerate it, right? And tolerating it is not going to get you
No, it's not going to get you
where you want to go. Would you tolerate a business, like in one of your employees treating your clients badly?
No, of course not.
But if you're not paying attention to it, it's not going to
It could
change.
happen.
It's not going to change. They go with their CPA. They hate the result. They just assume it's how it is and they move on. So they meet with their financial planner, which is not a
It's the same
financial
thing.
advisor, not a
It's the
financial advisor. It's a
well-
babysitter of money,
Even if it's wealth management,
babysitter of money, which leads me to my last thought as relates to this growth. If I could give any single client or any single person the best advice as it relates to growth, it's to make sure your money is in alignment with your vision. Now, let me explain to you what I mean by
please
that.
do.
If I meet you, I think I said this to you when I met you. If I meet you and I don't talk to you and I just look at your balance sheet, all of your assets minus your liabilities,
Right.
is it going to tell me your
Anything
vision?
about me? No.
All too often, the people you're getting advice from have biases. They're not bad people, but they have a bias because they have a product to sell. Financial advisors, wealth management advisors, they have
They're
a
all
product
the
to
same.
sell. It's okay. It's okay. Doesn't make them bad. It just is what it is. But they're going to tell you to invest with them. Well, what do we say is, where's your best investment typically? Your business.
Yes, in yourself and in your business.
But that doesn't pay them.
No.
That advice doesn't pay them. So all too often I meet with a business owner and I look at their balance sheet and it's like a bunch of 401k. They have some real estate and they have a bunch of money in an S&P 500 index.
Right.
But I say, hey, Bruce, tell me about your life. Like, where do you want to be in 5 years? Oh, I want to build this business. I want to sell it. And I also want to have a portfolio of
Real estate.
real estate. And I eventually want to have 50 doors so that I can retire on some mailbox money. Okay, Bruce, when do you think it's the best time to buy those 50 doors? Up markets or down markets?
All markets.
But most likely down markets.
You're right, but we can't time those markets. But I understand what you're saying.
But
you want to buy in a down market.
what ideally? But what's going to happen to your S&P 500 during a down market?
Your S&P is probably going to do the same thing.
Right. And your financial advisor is going to say, it's not the right time to sell. So your investments are not in alignment with your vision. If you're telling me you want to own 50 doors, you know where you should be investing?
In real estate.
In real estate right now.
Right.
Because you know what's happening? Those 50 doors, they're not getting any cheaper.
No, they're not going to get any cheaper. And
But you're not getting paid if you invest in real estate. You're a financial advisor.
So they're not going to advise you. And that's why they'll oftentimes say, maybe you should not take money out of that, or don't take money out of that account.
The trick of the trade is using the word diversify to scare you into thinking your financial decisions are bad ones.
But you mentioned just a few minutes ago, several opportunities of investments that would be for tax strategies or cost segregation, but your financial advisors, so to speak, aren't bringing these things to the table because they're not a product for them to sell.
Correct. Which is why we established the firm the way we did. We charge a flat fee for our work. I don't have a product to sell you.
Yeah, you don't have anything to sell.
We charge a flat fee for our work. That way the advice you're getting from us is completely unbiased. Whether you invest with me or you buy real estate or you go blow it at the blackjack table.
You're not telling me, hey, I can handle this investment. I'll be your stockbroker. You're not doing any of that.
No.
Yeah. Okay. So we've got about 15 more minutes or 10 minutes. After 10 minutes, we can do some questions and answers. What else do you think is important that someone knows? Now, I may have some non-self-employed people on this call that may be high net worth earners or high earners. Any advice for them? Or is that really out of the scope of this?
So what I would say is when most of your income is W-2, right?
Yes.
You're a high income earner. If you're not a business owner, it makes it really difficult for you to control tax strategy. But it doesn't change the concept of is where do you want to go? What is your vision? And invest your money towards that vision. All too often, whenever I meet high 401k or high W-2, they have a big 401k.
Right.
And I asked them, do you care to retire early? And they'll say, yeah, I would love to retire early. Your 401k is your main retirement asset. That's not available to your 60.
Right.
Is that what you want? No. But they did a 401k because their parents told them it was a good idea or because their employer wanted it to, and it's right there. I guess is take control. Take control of your decisions and get educated and work with somebody that doesn't have a bias, right? Chances are, if they're selling you a product, it's all they can do. Now, there's a lot of really great financial advisors out there. I hate dogging them because the industry is the problem. It's not the individual. And I believe the industry is changing. But the other part too is if I'm a W-2 earner as a tax strategy, I'm trying to figure out how to create a business that generates me some economically viable income.
Is there something that high earners that are W-2s that can do that the average person just doesn't know about? Or are they really just for self-employed people?
No, because the only way to offset a W-2 is either through negative K-1s.
Okay.
How do you get a negative K-1? You either have to have a loss of a business, which means you have to have a business, or you can invest in things that generate negative K-1s.
Okay.
Like, for example, if I'm a big W-2 guy, I'm looking at oil and gas partnerships.
Beautiful. I'm in them.
Yeah, because what it does is it allows for me to depreciate tangible and non-tangible drilling rights as a GP, which gives me a negative K-1 in year one. So if I put $1 in, I get a negative K-1 for $1.
Okay.
But it also generates a return. So if let's just say I invest $100,000, the average oil and gas fund is going to perform between 20 to 25% a year.
Okay.
But I get 100% deduction for going in.
It's insane. When you introduced that to me, I really had to wrap my head around it. But these are things that you're saying a W-2 wage earner can
Yes,
also do
absolutely.
that will
So I
help.
just finished working with a W-2 individual. She was making $750,000 a year, but she also had some in real estate that was generating some economically viable income in her real estate management company. So we were able to make some incredible decisions in that company to reduce that income down from 58,000 to a negative 244,000. That negative K1 impacts her W-2. And then we invested 150,000 to oil and gas.
But you're not physically losing money.
Nope. But these are all dollars she's already spending. She has a cell phone bill. She has rent. She's got marketing expenses. She's got all kinds of expenses that before were not being deducted anywhere because you couldn't on the W-2. She bought herself a car that was $100,000 that we were able to depreciate on the 1099 side. So this $750,000 individual, was paying a 45% effective tax rate.
Wow.
When we were done, her income was down to 220,000, which brought her bracket down. So her effective tax rate was 9.2.
That's insanity. One of the things that I hear,
What's 30% of 750? A money, dude.
a lot of
money.
When we're talking about investing and having there, because there are good tax advisors, but one of the things that I hear on a regular basis is, oh, my bank or my financial advisor has me into a high income investment. And I'm like, what do you mean by that? Yeah, my bank's giving me 5.2% on my money. I'm like, that's a high income investment? I don't understand why, but banks are selling this right and left. And I know that we're in an inverted yield curve. So there can be some short-term gains on, or some gains on shorter-term investments, right?
Yes.
But aside from that, when I hear people invest in that, do you have anything, is there any advice you can give for that type of thing, that investor that really doesn't know what to do? They don't know where to go.
One, call us.
Okay.
Two is really build kind of an investment philosophy for yourself. Do a little bit of research and then try to identify what you're trying to accomplish, because all investments are good and all investments are bad, depending on what the goal is.
Okay.
If you're telling me you're investing money into a high yield savings account making 5% that you're never going to touch for 30 years, that makes that a bad investment.
Yes.
But if you're telling me you need that money to put a down payment on a house in 6 months,
that's
a
the story.
great investment.
That's a different story because you're going to take it out in 6 months.
So it really comes down to what they're trying to accomplish. And from an investment perspective, again, I cannot be more on this. As an entrepreneur, as a business owner, focus on cash flow.
Okay.
If you start having cash flow conversations with your financial advisor, with your wealth management team, or whoever, you're going to see a complete change in picture, because return and average return are two vastly different conversations.
Okay.
And what I mean by that is
that
the S&P 500 has averaged 12% in the last 10 years.
Yep.
Okay. That does not mean
even longer than that.
That does not mean I'm getting a 12% return per year.
No,
I know.
You got 7 on one. You might have got 15 on another.
So when we start thinking about cash flow, that investment is a 6% cash flow asset.
Help me understand that, Dan.
What I mean by that is the most a financial advisor is going to be comfortable with distributing from a cash flow perspective in that investment is somewhere between 4 and 6%.
Okay.
So the cash flow picture changes things. So now, you know, as a business owner, if I'm going to invest in something, I can't count on 12. I can count on 6.
Right.
That's different.
That's a whole different story.
Because you know what that does? When you think about cash flow, it adjusts it for risk.
Yes. And we have to adjust depending on your temperature.
But then you can compare things apples to apples. Does it make more sense for me to invest in the S&P 500, or does it make more sense for me to buy this piece of property?
Okay.
Cash flow adjusted.
And you help your clients with that as well.
So what we do is we build the thesis for that. We build the formula.
And then they can go.
What's your buy box? What's your investment buy box? If you plug the numbers in and it hits the buy box, make the investment.
So you also help a lot of people with investment strategies, but you don't consider yourself to be a financial advisor. You suggest that people have their own financial advisors, or at least have somebody. So I go to I keep my money in Charles Schwab. You help me diversify my money from my investment accounts into other sectors.
Yeah.
So you're not controlling that money. I'm controlling the money. You're just telling me you should do that. You should put it here. I'm going to get you a tax advantage. We're going to buy oil and gas. We're going to buy pallets. We're going to buy rental equipment.
Now I'm fully licensed, right? Full 766, 63. I am a title financial advisor, wealth management advisor.
Yes.
I just operate as a business consultant and an advisor before a financial advisor because I think that's the right
Well,
way.
it's not a conflict of interest.
That's the right way. There's
You
no
know,
bias.
It's like the home inspector giving you a quote on fixing your house. Okay. And I say that because it's happening to me right now. I'm like, I think we may have a conflict of interest going on here, but it's the same thing. So you will paint the picture and then they can go to their tax advisor or
No, I'm going to paint the picture and then I'm going to go to their advisors for them. Because your job, Bruce, you know this,
is to do mortgages.
is to do mortgages.
Yes.
Not to translate my work to somebody else.
I love that.
The reason I meet with your CPA, I meet with your insurance agent, I meet with all of them is because I'm going to get the job done. And I don't need you to go learn my job to then go try and translate it to them. No.
You can speak their language where I can't.
Exactly.
It's like me talking to the wife about doing a refinance and that she's going to try to interpret to her husband that couldn't make the meeting. That's not fair.
How often do your clients talk to the underwriters?
Never.
Why?
Because they're
It would
not
be an absolute disaster.
It would be, oh, you'd never get a loan approved.
That's my point is I don't want you to talk to your CPA. Do you want a good tax strategy?
Yes.
Let me do my job.
Beautiful. And you do that. And you have actually teams of people that not just do tax strategies. You have another team that goes through life insurance and audits it and make sure you're in the right insurance,
Right.
where you're invested. You audited my will and trust. Oh, I think there's several other things we did as well.
Yeah, we're not going to be able to,
We're not going to cover all of it, but I wanted to give them a little bit of a flavor to what you do, because I think there's other opportunities for you and I to do another interview that might take this to a different level that might get their attention as well. I think this has been great. I think we should open it up for some questions. Has anybody got any questions for us? And can we see these?
I would say, Justin, a lot of the stuff is going to start to apply immediately from the growth and alignment and the thesis perspective. At a tax strategy perspective, you're looking at anything over 6 figures of income.
Good.
So that could mean $1 million business. That can mean a $300,000 business. It just depends on the margin and the profit of your business. But tax strategy really starts to be impactful at around $100,000
Yes.
of income. It really moves the needle at 250, and it's a no-brainer at 500.
Yes. So you're at even 300.
Yeah.
Even 300 and above, you really should be looking at doing something. If you're self-employed, for sure. W-2, maybe not so much.
I don't know, 300, any 300.
So you can help somebody making 300 on W-2.
Yes.
Perfect. All right. What other questions might we have? Anybody else out there? Okay. So we've covered a lot of ground. I think we've learned a lot. Most of it is, I know, but you believe that you think people know what they should do with their CPA. I personally think I think people don't know what they don't know what they don't know. And so we don't know, and we don't challenge people because we don't understand what they do.
Yeah.
So we give the taxes to, and like you said, it's a lag effect too. It's already happened.
So here's what we'll do, okay? And you can shoot this out to people that have maybe already left. Follow me on Instagram, okay? At Claude Gambin, at CLAUDGAMBIN. Maybe we can throw that in the notes.
I can send it to everybody.
Send me a DM.
Okay.
And I will send you a free link to our tax calculator.
Okay.
You can plug in your information and it's going to spit out all the strategies that you should be looking at, and then take that to your CPA and go fix it.
Okay. All right. Good.
And then a lot of this content
that's
is
a great
on
offer.
all of our, and if you follow me and you said, text me Bruce Woodburn or whatever to do with this, I'll send you any free resource I can, and we'll go from there.
I want to thank you, first of all, Claudio, for helping us all understand, because a lot of this was new to me, and I felt that it was important that I share it with other people that don't know about it, because I wouldn't have known about it if I wasn't introduced to you. So you've been a great help to me. I think our next one, we should be maybe a little bit more on strategic investments
Sure.
and some ideas that we may be able to come up with from that as well. So I want to thank everybody. We got a question.
Doing their own taxes. It's doing their own tax.
Yeah, I think anything under six figures, you got to be really careful with the expense. The average CPA is going to charge you X to do your taxes.
Right.
And there's probably not enough there for you to really move the needle to make the value there.
So that's when a TurboTax or
A
an H&R
TurboTax,
Block.
yeah,
Block
I
or
think
something.
that would make the most sense.
Yeah. And personally, I would prefer somebody go to a local CPA or tax preparer that they know. I'm not big on the TurboTaxes because I know that companies like that can sell data. They're data mining companies, just like having your credit pulled on Credit Karma, going on Zillow. They're mining data and they're selling data. So I'm not big on those type of things. But for somebody that may make under $100,000, H&R Block, or call me and I'll connect you with a tax preparer.
For
Any other questions before we go? We're good to go. Thank you guys very much. Thank you very much. Appreciate all you've done
always
for
a
me.
pleasure.